Okay, let's take a quick look at the TFSA tax-free savings account versus RRSP registered retirement savings plan. Your main, well, it's your tax-free option versus your tax deferral option. What you're going to find is that for many families, they should really be maxing out their tax-free savings account and then even questioning whether they want to put money in an RRSP. But more on that later. So today, we're choosing British Columbia as our province. It doesn't really make too much of a difference, though you may pay higher tax rates and be in a different tax bracket depending which province you're in. Taxable income, the RRSP was actually developed around the notion that we're going to live on less taxable income when we retired than when we were working, which is the time we're contributing. So we're contributing when we work, we're withdrawing when we've retired. But that's not really how things have turned out for a lot of people, uh, depending on how they're doing financially. But we have taxable sources of income for most people with the Canada Pension Plan and Old Age Security. And then if you're piling on a bunch of RRSP income on top of that, you are really starting to push up your taxable income in retirement. So that's not really a valid assumption any longer. And so I'm setting us at having the same taxable income when we contribute and when we're withdrawing. Um, and I'm looking at a contribution amount of $10,000. Depends how much you're putting in, of course, but let's say it's $10,000. Right now, if you're haven't contributed to a tax-free savings account, then you've been eligible for it since it was first created. That is, you were the age of 19 when the TFSA was first created. You could contribute. You have a maximum lifetime contribution right now of $95,000, and that increases by $7,000 a year. Okay, so another assumption: are we investing or spending the so-called refund we get from the RRSP? I'm setting it to spending because that's what most people do. They spend their RRSP refund. That is not the wise choice, but that is what they do. So um, if that gets them to invest, well, so be it. But that's not the best possible decision. So we're looking at years of growth, 25 years. So for example, if you're in your maybe you're 40 to 45 years old, 25 years away from retirement, earning $80,000 now, you're probably going to increase your income. Well, you will likely increase your income, and perhaps quite substantially by the time you get closer to retirement. Our peak earning years tend to be the last 10 years we work. So I'm allowing 25 years of growth and just for illustration purposes, a rate of return of 8%. So let's go to the numbers. 25 years later, what do things look like? Well, I'll tell you what they look like. They look like you're really going to be happy if you contributed to the tax-free savings account because with your $10,000, with your tax-free savings account, you started with $10,000 of earned income. You paid $2,820 in tax in that year when you contributed. So you actually only contributed $7,180. Whereas with the RRSP, you contributed, you took your 10,000, but you spent 2,820 of it as your refund, and so your after-tax contribution was 7,180. So investment value in 25 years, 49,172. Same amount of money, etc., grown for a bunch of years. So your money's grown by about fivefold in that period of time. However, because you are drawing from a taxable source with your RRSP, you're going to pay $14,000 almost in income tax in retirement there. So you're only going to have $35,000 in after-tax spending in retirement because you contributed to the RRSP, whereas if you contributed the tax-free savings account, you'd have had 49,172. Or if you want to really compare where the issue is here, you paid $2,820 in tax when you were 45 so that you would not have to pay 13, almost $14,000 in tax when you were in retirement. And that's why we look at doing the TFSA as a much higher priority than the RRSP for typical Canadian families. You really need to analyze all the way through what's going to happen with taxation, both at the time you're earning the income and at the time you're going to be living off your investments, your assets, when you hit retirement. That's why you really need comprehensive financial planning, because this, just as an example, the most recent family that we're using as an example that we did a plan for, using the same amount of money. So just like we're showing here, the same amount of money, that family over the life of their retirement and with the legacy they're leaving behind, using the same amount of contribution money, is going to enjoy about nearly $600,000 in additional spending and legacy compared to what would have happened if they hadn't done their plan. So always makes sense to make that plan. If you want to know more, check out our master class. We go through the principles and we give that actual illustration in there. Hope you found this helpful.